Hello, everyone. My name is Julie Sutter, and as IAEE's Executive Director, I am pleased to welcome you to today's webinar, Oil and Gas Navigating Growth and Challenges in 2025 and Beyond. We are grateful to Dean Foreman and Isabella Ruble for preparing today's presentation and moderated discussion. We will continue to explore energy issues in energy transition in webinars scheduled in April and May. Please watch your inbox for announcements about registration. These sessions are complimentary for IAEE members. The 46th IAEE International Conference will be held in Paris this June. We're building an outstanding program and hope that you will join us as we explore the topic of energy solutions for a sustainable and inclusive future. A few housekeeping matters before I hand things over to our moderator. This webinar is being recorded for those who cannot participate in today's live event. If you have questions for the panelists, please click the Q&A button at the bottom of the Zoom window and type your question. We have allocated time at the end of the webinar to address questions. After the webinar, we will send a survey and would appreciate your feedback. Please take a few minutes to complete it. And now I would like to introduce you to our moderator, Dr. Isabella Ruble, an economist at the U.S. Department of Energy. Dr. Ruble is also an associate editor for the Journal of Economic Asymmetries and the owner of the Weck Institute. Isabella, over to you.
Thank you, Julie. Good morning, everyone around the world, or good afternoon in some parts of the world. I welcome our audience. I'm happy you could make the time to join us today. I would also like to welcome, of course, our distinguished speaker, Dr. Dean Foreman. It's a great honor to have you here at IAEE. Dr. Dean Foreman serves as the chief economist for the Texas Oil and Gas Association, where he leads critical economic and energy policy analysis, advancing the understanding of Texas oil and natural gas industry. With over 2 decades of experience, Dr. Foreman specializes in global and domestic policy analysis, market forecasting, corporate strategy, and risk management. He holds a PhD from the University of Florida and has held leadership roles with prominent organizations, including ExxonMobil, Talisman Energy, Sasol, Saudi Aramco, and the American Petroleum Institute. His expertise has informed strategic decisions, legislative initiatives, and regulatory frameworks, shaping the energy industry at both the national and global levels. Welcome, Dr. Foreman.
Thank you so much, Isabella and Julie, for inviting me. So I'm, just honored to be able to have a nice conversation with the group. I'm going to ask, I guess, that we hold questions to the end, and I'll try to stay on schedule here. Texas Oil and Gas Association, why are we concerned about global energy? Texas is obviously an epicenter for a lot of U.S. energy development, the major source of growth, exports. In my career, we are now representing some 90% of the industry. We're the largest trade association representing the industry for regulatory and legislative purposes in the state. I did a similar job with the American Petroleum Institute in Washington, D.C. for the last 5 years, and I've spent over 20 years in the industry, as you mentioned. And the thing that it comes back to, really, having trained as an economist, really focused on measurement and thinking about the microeconomics of it in terms of training, is that my career has been predominantly macro focused. And whether it's National Petroleum Council studies, academic research, corporate planning over the years, the demand side, which tends to be the poor stepsister of a lot of the outlook systems, has been relatively more consistent, give or take the pandemic, and how we projected out the long run. Energy intensity, elasticity models, really using simulations, but also econometrics to get that right and calibrate it. The supply side has been a lot more interesting, and we've seen some unexpected shifts, including the shale revolution, emerging technologies, and today's question about how far and how fast you can go with the transition, given emerging technologies backed by government incentives. To me, it comes back to the economics of it, and I'm going to share a presentation here. Bring my screen up. You're going to see a quarterly outlook, and I do things at the weekly, the monthly, and the quarterly level. This is more of a management level presentation designed to kind of frame it all and tell a story through pictures that I think tell 1,000 words. I'll start with the high level messages. And right now, with the economy, the macroeconomy, trade, tariffs, it's never been a more interesting time. I mean, everything in the headlines day by day has a feel of almost structural shifts. These are things that you don't see every day, and it is outsized compared to what we saw even during the first Trump administration. For economic growth, until this year, the last 2 years, and let's regard the International Monetary Fund as the arbiter of official economic data, we had kind of come in with expectations that, frankly, were sandbagged. And we said, well, look, we're going to exceed that. We're going to exceed that. And things continued to exceed a low bar each of the last 2 years. And as global growth goes, energy demand, especially oil and gas, also go hand in hand. And yeah, that's why we're focused on the macro thing. But I build it up for 200 countries individually, looking at the data and really weighting it on apples to apples market exchange rate basis, and then calibrating the energy data on a consistent basis with that. And it's interesting this year, as opposed to sandbagged estimates, I've come in seeing upgrades at year end, especially for the US and China in the IMF outlook. And so it looks like it has downside to it. And sure enough, come January, with the IMF's changes, it clipped about 0.2% off of that. So again, on a market exchange rate basis, a global average this and next year of 2.6% growth. And for oil, just divide by two, roughly speaking, a little less than two. But that would tell you that you need roughly 1.3 million barrels per day more oil this year compared with last to meet global demand with that quantum of growth. And given the energy intensity of the economy, and it's come down over time, it continues to make progress. Roughly speaking, you still need that quantum of growth, give or take some market conditions. Trade and tariffs could make this interesting, and we need to see, with the strongest US dollar on record, when we look at the Federal Reserve's broad dollar index, that affects terms of trade, emerging market debt. I mean, there are a lot of scenarios, plus the consumer effects that have really been the self-fulfilling virtuous cycle for the US economy in terms of spending and growth. These are the things that we're going to tease out through some of the presentation. But by the numbers, and we should expect, with the threat of tariffs coming, that we're going to see some activity front loaded into the beginning of this year. The numbers are going to look decent for the first quarter. I'll talk about the Atlanta Fed and their real-time indication of US GDP, which is a little bit less certain. But in the way and the indicators that I look at on a weekly basis, by the numbers, it looks like a solid start to the year, with a lot of risk for both things that cyclically would have expected to slow this year, compounded by these uncertainties that are coming on the policy front, both trade policies as well as monetary policy. For oil, by the Energy Information Administration's expectations, we set a record in terms of demand last year. That correct, turned out to be the case. Over 104 million barrels per day for this year, growing by 1.3, so roughly half of the expected growth in GDP. And then another 1.1 million barrels per day of growth in 2026, projected to eclipse 105 million barrels per day. So this will be 4 consecutive world records for the amount of demand if this plays out as expected. The worst kept secret here is that even if we hit a recession-like scenario, with the exception of what we saw during the pandemic in 2008 and 9 with the great financial crisis, it's pretty rare that the global economy actually shrinks, right? So if slow growth is at or below around 2%, instead of 2.5 or 2.6% to be precise here, oil demand is still likely to grow on a global basis. So, again, divide by two. If you're talking still the better part of 1 million barrels per day of growth per year, this is why the market, despite a lot of new supply sources coming over time, has tended to keep it together. The real tension in reading the tea leaves on this is not just the demand side and the amount of growth, but where the supply comes from. What's special about this year is that we have a lot of non-OPEC long lead conventional projects from Guyana, Brazil, Norway, and Canada coming on stream, and combined total adding over 1 million barrels per day of new supply this year. The US is still the single largest source of growth. It was last year in terms of oil supply growth. It's expected to continue to add several 100,000 barrels per day again this year. So together, then that creates a question of, what does OPEC Plus do, and what happens with the resolution of the war in Ukraine. These things are things that I think we'll have to tease out in the course of the presentation. But right now, if the economy stays on track, there's enough headroom in terms of demand growth to enable a mix of supply and for OPEC Plus to put some barrels back on market, as they've announced that they plan to do. On top of that, you have the Trump administration also adding pressure both domestically and internationally to increase supply. I've gotten questions recently this week about whether the downdraft in oil prices, coming down into the, for U.S. prices, mid to upper $60 per barrel range, whether that's really, concern for economic growth or a supply side phenomenon. And I got to tell you, based on the expectation that Russia's war in Ukraine will be resolved, that may lift some of the sanctions on Russia, plus the pressure and the encouragement to try to increase supply, both OPEC plus and domestically. I think that's really the supply-driven effect of what we've seen in terms of prices. And when we look, I will show you a mean reversion analysis, both for oil and gas, and kind of looking at where the history is relative to where futures markets are and putting codes of uncertainty around that. And this would say oil's still at this level relatively balanced. It's been in a range historically, and it continues to be basically on par. Natural gas is different. It's similar in that it's also hitting records and expected to project to do so over the next 2 years. What is different is that we've gone through kind of structural changes of after two relatively warm winters across the northern hemisphere the last 2 years. We went back to a pseudo-normal winter this year, and that's changed futures markets expectations, where they've structurally shifted up over the next year to 2 years, at least domestic prices have. And there's an increasing market realization that the US is also serving an increasingly global backstopping role in terms of inventories and exports. So we're seeing the maturation of global gas markets and LNG increasingly tying the regional prices together in a way that's interesting. It hasn't happened quite this way before. And when we look at the mean reversion analysis, you'll see that it looks like the market's expecting tighter conditions to come over the next year or two, and that's a difference from what we've seen over the last year. So I'll highlight that. In a nutshell, not a bad outlook. I mean, it looks like we're set for records here, but the uncertainties and a zero-sum nature of some of the policies that might play out really add to the complication of it. So I'm going to spend a little time on the economy and tease out some of these issues in a little more detail. The growth outlook globally of 2.6% per year the next two. We've talked about the uncertainties in terms of what this could mean from a policy standpoint, both for spending that's driving it, consumer sentiment that in the last week or so we've continued to see drop, historically large drops, at least on a month-over-month basis. And then the strong US dollar that I mentioned, the strongest on record. It's just a matter of time before the IMF, the Bank for International Settlements, start dusting off old research papers about a potential sovereign debt crisis, right? Because half of sovereign debt is US dollar denominated. We're talking about $5 trillion worth of it globally. And as terms of trade are degraded on top of this really strong US dollar and tariff policies, it creates headwinds. And we're seeing it to the day where people are changing their expectations for how much growth in developed economies like Canada as a result of tariffs. And then what happens with Mexico? What happens as we go on down countries that have dollar denominated debt here? That will be one of the big uncertainties. The strong dollar has historically had an inverse relationship with crude oil prices. Breaking out on the left here, the year-on-year appreciation or depreciation of the dollar versus main currencies, huge appreciation versus Mexico and Brazil on exactly the tariff expectations that have been happening, Canada as well. We're under 70 cents per US dollar for the Canadian dollar now, and it raises concerns about the sustainability of their economic growth. And it's hard to plan forward with major supply chain and other industrial investments on that basis if you're having major uncertainty about how the industrial conditions will change. This relationship shown here on a quarterly basis between Brent crude oil prices on the vertical axis and the strength of the US dollar. This is the Federal Reserve's broad nominal index on the horizontal. It's been pretty tight, and it's held over almost 2 decades here. Notice the red dot for the first quarter. This is to today, the average through the first quarter. we have the strongest dollar on record. It's amazing, and this relationship is held. And it also, if you think about what the trading dynamics mean for commodities in a pro-inflationary environment, if you think about whether this is just mechanically what it does to raising, if you got a really strong US dollar, oil is traded in dollars, you're raising in local currency terms the cost of imported oil, in emerging markets around the world. There are reasons this inverse relationship naturally goes. And if I expect more inflation from commodity standpoint, I can hedge it partially using commodities, including oil here. So this is held, it's held tight. The question is, will the dollar be as strong or go even stronger given the tariff environment that's emerging? And we'll talk about that next. A lot of the Trump administration's prospective policies, the things they'd like to accomplish, would actually be better accomplished with a slightly weaker dollar. And I don't mean a historically weak dollar. I just mean one that's not at the extreme end of the highest dollar on record. And that's a challenge because many of the things with paying back debt in a higher or more normal interest rate environment with a very strong dollar is not exactly the way this would play out. So we need to see from a tariff perspective now what this does. And I I've been focused a lot in recent quarters on Texas's relationship with Mexico in particular and where that has come from. And this is zooming out to a US level of five, just five product categories. If we go to the two-digit harmonized trade schedule codes, five product categories that account for $1.8 trillion of imports, two-thirds roughly of the US trade deficit in goods. Since we run a surplus on services, this is actually close to 90% of the overall trade balance sitting in five product categories. So it won't be a mystery to you that these are the categories that are exactly getting targeted by the administration right now. And by the way, to extend the tax cuts that the 2017 tax cuts that were put in place by Trump administration one, to extend those now, and they expire this year, it's going to require a revenue source. And enveloping a lot of trade with our major trade partners of Canada, Mexico, and China within this is one way to raise that revenue that's needed for those tax cuts. So I was listening to Howard Lutnick talking on behalf of the administration this morning about, first focusing on negotiations with Canada today and making fentanyl and other things a primary issue. At the end of the day, they need to pay for. And when we look at the categories, you've got almost over $500 billion last year of it shows up in the trade data as nuclear reactors, boilers, and other things. But when you go into HTS 24, or excuse me, 84 as a category, it really is high performance computing. It's servers, it's chips, it's processing units, RAM memory, motherboards. There are also some aircraft engines, tractor engines, and other components in there. But make no mistake that the computing component of this that's not easily substituted, a lot of it coming from Mexico, China, Taiwan, South Korea, Japan, is ultimately critical. Next, we go to smartphones, batteries, things that, again, aren't easily substituted in terms of manufacturing in the US. It's something that every household wants. Everybody has an iPhone or the equivalent Android device. Then we go to vehicles and parts. Again, now some of that could change and it's been announced maybe to change in terms of origin over time, but that's hard to change in the very near term. So in the near term, these constraints could be inflationary. Then we get to crude oil, over 240 billion of crude oil imports. And people say, and the administration has said, well, why should we import it all? Because we produce so much. And it really is about geography and the grade of crude oil. On the east and west coasts, it's still without the pipeline infrastructure connecting the production center and refining center of the country. It's still much more economic for New England or California to import crude oil and products at times. Sometimes it's seasonal, but we don't have the infrastructure in place to easily substitute that. And there's a reason, despite domestic crude oil having been so abundant and cost effective, that infrastructure hasn't changed. The other aspect of this, besides just the geography, is that investments have historically been made through the middle of the country to take advantage of Canadian heavy crude oil or crude oil that's heavy from Venezuela. These are uniquely heavy crude oils that are so heavy, bitumen, tar, that they have to have light oil inserted into it just to be moved through a pipeline. In this case, we took the vast majority of this is Canadian crude oil imports. And there's announced that effective as of yesterday, a 10% tariff on that. We can talk about what that means in terms of the economics. In the short term, given the current prices, historically, the difference between domestic light oil and Canadian heavy oil, this is held together and it should be able to absorb it at this rate. But some of this might get absorbed by Canadian producers. Some of it could show up in depreciation of the Canadian dollar. If the tariff ratchets up in the longer term, and we have some analogs that we could talk about for what that might look like, then you start talking about either substituting other heavy crude oil or investing in upgrades to be able to reprocess the bottom of the barrel from distillation and other processes. So we have an example in 2018 where Alberta put production restrictions on and raised artificially the price of Canadian crude oil in a way that the difference versus light oil domestically uh, was historically narrow. And when that gets below about $10 per barrel, people tend to say, nope, the economic incentive isn't strong enough to process this. And we've seen that happen historically. When it has, people have either shifted to other imports if they're on the coast and can do that, or they just don't run as hard. The capacity utilization rate on complex refining units. And in that case, they can invest to take residual fuel oil from the distillation processes, upgrade it, move it. There was a regulatory change in 2020 called IMO, International Maritime Organization 2020, that was intended to phase bunker fuel, heavy residual fuel oil being burned directly in marine shipping. And that had been the major market for the bottom of the barrel. So when you phase that out, people had to necessarily invest. And that coincided after that 2018 change in Canada of putting production restrictions in Alberta on heavy crude oil. That coincided with investments on the Gulf Coast that ultimately cost Canada market share. So at a 10% tariff, I think the market adjusts. If it goes to 25, and that is the talk, that these things will be symmetric and potentially ratchet up. If that is the case, then it's more structural for oil markets in terms of the refining mix. And the other question on top of this will be what happens with tariff retaliation. So if you start both putting an import tariff on what's going into refineries and also having, again, symmetric 10 to 25% tariff on refined product exports, that could have the longer term effect of shifting a lot of refining activity to Asia Pacific and the Middle East. So that was a nice diversion into refining and tariffs and trade. In a nutshell, there are a couple of real-time reads on US GDP growth, and think of this as a leading indicator and a major component of where global growth goes. The ADS index, a Ruble Diebold Scotty index published by the Philadelphia Federal Reserve Bank, is a great indicator. Think of it as a real-time read, daily read on what US GDP is doing. It's almost ever wrong when you average it out. You see how it lines up with actual GDP growth, and it says things have accelerated this quarter. Now, where this can change is that with any factor analysis and composite index like this, where you're factoring in industrial production, for example, that might be a month or two in arrears, you could see this get revised down some, and I think that could happen. But it still says that it's historically solid growth in the first quarter. I mentioned that a lot of expectations of advanced activity into the first quarter. I still expect that's the case. And the question then is what actually rubber hits the road, changes in terms of trade and tariffs. We'll talk about consumer sentiment next as it interacts with the amount of debt that American households are carrying. It's never been higher, over $18 trillion as of the fourth quarter for the New York Federal Reserve Bank. What's interesting is that as the economy grows and incomes are growing, people can also bear more debt. But we're seeing delinquencies on credit cards, mortgages, and auto loans raised to some historically high levels here. That's the concern. So when 70% of the economy on an expenditure basis is driven by consumer spending growth, how people feel personally about their wealth, their income, their job prospects, and the ability to have headroom to use their savings to spend. I will add that in economist groups that I interact with, the conventional wisdom here is that you have an income pyramid, and that since the pandemic, lower income households have been relatively more stressed. The term people often use is the K-shaped economy. Some do well, others don't. But credit card companies have shared that they're seeing things in the data that they've never seen before. They're seeing affluent households start to, large percentages of them only making minimum payments on credit cards. That's a sign of broad-based stress. And you wouldn't take consumer sentiment indicators per se and just say, no, I look at weakness in consumer spending going forward just because, in 1 month, and we just saw a historically large drop in consumer sentiment. Part of it is that people are scared about inflation. They're seeing an unavailability of eggs. I mean, it is rubber hits the road in terms of what they personally experience and how they feel about their own prospects. But you're also seeing the announcements of job layoffs. It's been the tech sector in the last year or so, and we've seen a lot of job creation on the government and services side, but now the government side is under a lot of pressure, especially federally. So it does beg the question of what happens with job trends. The Federal Reserve, in terms of interest rate policy, is somewhat constrained by where inflation is sitting. It's not come down to their target level. They have a dual mandate to try to manage employment, but the question is, how much headroom is there? And if things do start to soften, can they really cut rates? So with that, we're going to shift to oil. The I already mentioned the 2-to-1 ratio between economic growth and oil demand growth on a global basis. You see it here on the left. Global oil demand on the vertical, the size of the global economy on the horizontal axis. From 2000 to 2019, an almost linear trend. And even the great financial crisis is just a blip on the scale for demand. Uh, the COVID recession shutting down sectors of the economy was obviously huge. And then as of last year, we're at and above these record levels and projected to grow here. And you see the EIA projections now out to above the 105 million barrels per day in 2026. In terms of headlines, it really is a debate now about how the supply side fits into a box where we're expecting and baking in some continued demand growth. Shifting to supply and looking at the seriatim where it comes from, I mentioned the US has been the greatest source, expected to add more than 300,000 barrels per day again this year. Other non-OPEC, 500,000 this year, 300,000 barrels per day next year. Non-OPEC nations collectively, and this is Guyana, Brazil, Norway, Canada, adding over 1 million barrels per day this year. And that's expected to slow next year. And as that slows, if that slows, as EIA expects, that opens up headroom for OPEC and Russia to put more back on market. As Russia, and assuming the Russia-Ukraine war is resolved, you might expect that they could put more pressure back on Iran without tipping over the supply balance. We'll have to see how that plays out. But the conventional wisdom of just statically saying, no, they're going to flood the market. No, it's very well informed. I've been on that side of it. I've had the honor of working both in Canada and Saudi Arabia. I will tell you that the understanding of revenue elasticities and how the market impacts go are very much part and parcel here. And I think the political pressure also to try to tamp down oil prices so that that lowers fuel prices and at least provides some sense of consumer relief amid other inflationary pressures. That's part of it here. And what's interesting to me in EIA's outlook in terms of the storage balance versus prices, as shown on the right, is that they are expecting continued storage withdrawals over the next year to 2 years, yet they see prices easing. So, on balance, this says it's interesting that our inventory is already historically low, but we could see more comfort from the market in terms of pricing. Two flavors of U.S. inventories: strategic petroleum reserves and then those held by industry. In a nutshell, during the Biden administration, we basically cut the strategic petroleum reserve in half. We've seen that being rebuilt, almost 10% increase in it over the last year. Crude oil stocks held by industry until the last couple of months were really at the bottom of the 5-year range, but just in the last 4 to 6 weeks, we've seen it come up into the middle of the range, which is a healthy sign that at least that's normalizing. And I mentioned mean reversion analysis. I think for an advanced economist group, maybe you or I won't have to explain a lot of this, but you take historical prices, you fit a nonlinear curve, the best fit through that, and then you measure the speed of reversion and the amplitude around it to put cones of uncertainty going forward. It is not a forecast, and as Trade Association for Antitrust reasons, we don't offer a forecast. But it is a comparison of the historical mean reversion threshold with futures prices shown on the white dotted line, and then putting 50, 90, 99% confidence intervals around it. And this says that the historical mean and the futures really mesh, that they're really close. There's more potential upside than downside. But roughly speaking, this is a market that's in balance based on the historical indications here. So let's go to gas quickly, and then I'll try to open to questions. Similar story, economy versus gas growth, stronger historical elasticity, more like 0.9 instead of 0.5, for gas. But Russia's war in Ukraine changed that, and we've seen much slower growth since 2022 as a result of that. But yet we are looking at, and again, the economy growing 2.6%, the official projections from the International Energy Agency here, and also EIA, theirs are more in arrears through their International Energy Outlook, but growth of 1.8% this year and 1.5% in 2026. So continuing to grow, continuing to make progress despite the disruption of Russia's war in Ukraine, and with the price pressures, thinking that natural gas is much more expensive, relatively speaking, than it is in the US, both in Europe and Asia. We've seen landed gas prices in Asia and in Europe with winter conditions here going as high as $14 per million BTU. So we've gone from historic lows. We've seen volatility come back. Historically, when that volatility comes, utilities ask, should I continue to invest in natural gas? Will it be as abundant and cost effective relative to other sources? And it's the first time in a couple of years we've gone back through that debate, given that since the middle of last year through really November, December, when you adjust for price inflation, we had the lowest domestic natural gas prices in history. So look, the system continues to grow here. And US exports, US changing the business model for it in terms of LNG, contractual and destination flexibility, indexed back to Henry Hub, a different pricing model than historically international gas has had. We're seeing continued not just production growth, but the exports of it growing, expected to go up to 18.6 billion cubic feet per day. And this is kind of baked in. This isn't a pie in the sky projection from EIA in the sense that the terminals that are under construction usually are locking in firm gas sales, purchase and sales agreements for the next year or two as they begin. So it's just the question of how fast, is their construction staying on time and on budget, or are they actually ramping up their capacity in the timeline that's expected and advertised here? One thing that has been really important is NGL extraction. We have been hitting in Texas almost 4 million barrels per day of NGLs, nationwide around 7 million barrels per day. So in addition to crude oil, which has been at or near records of around 13.5 million barrels per day, we're adding almost 7 of just NGLs. So it's petrochemical markets. Some of it feeds into the gasoline pool, but it's primarily petrochemical markets that pose an economic decision of whether to take these liquids out of the natural gas stream. They can be kept in natural gas to a point, as long as it's compliant and not increasing the BTU content of the natural gas beyond pipeline specifications. But as we here also export more LNG, keep in mind that you take the NGLs out necessarily because you're exporting dry natural gas. That's what you are cryogenically bringing down and compressing and transporting around the world. So that's been a boon for U.S. petrochemicals. And then now this trade and tariff scenario interacts with this because your petrochemical value chain and your manufacturer's value chain both depends on, again, utilizing what you have domestically, whether there's any imports that come from this. Heavy oil tends to give you more in the petrochemical side in terms of complex molecules that can feed a wide variety of products. And then if we get retaliatory tariffs, that becomes interesting. Gas is always a storage-based thing. It's very regional, it's very seasonal. You expect this. We had been having historically high storage, again, up until historically large withdrawals through this normal or return to normal winter. So we're now it's still in the 5-year range, but it's on the lower end of it. And that's caused futures markets to respond in terms of their price expectations. So the same kind of thing, and we're using a lot more years than what's shown here to create this analysis. So, because otherwise the meaner version, the black dot line doesn't look like a fantastic fit with the peakiness of the data. But it is a good fit overall. And this is where we've seen things where a few weeks ago it was in equilibrium, just like the oil chart, to now seeing futures markets having structurally shifted their forecast up, expecting tighter conditions over the next year to 2 years. This is interesting. It's also also, like oil, has more upside than downside based on historical relationships. But the question is, does this shift back down, or is it truly a structural shift where it stays tighter? And that's one of the things that we have to continue to monitor. Last 2 points, productivity. Um, and we look at rig productivity in the United States. We track this at a very granular level. This is truly technology driven. There are longer lateral lengths, well lengths that are adding to some of the gains. So a well today is not the same as a well 5 and 10 years ago. But in terms of data visualization, analytics, real-time learning, and targeting of resources, it's fundamentally improving the resource recoveries. And keep in mind that a decade ago, people didn't really understand why hydraulic fracturing worked at a molecular level. Today, they have much better understanding. And as opposed to the last decade of really having growth for its own sake, and adding resource additions in terms of proved reserves, today it really is about efficiency and efficacy and it's not the biggest initial production out of each well, but they really are managing to optimize the recoveries over time. And we're seeing this. To keep in mind, the amount of year-on-year gains in terms of rig productivity with the updated estimates from EIA as of January, almost 8% year on year from the Permian Basin, almost 11 in the Eagle Ford, 3% still in the Haynesville. That's that's solid. And then we use what's called a rig pulse model. So we translate this then year by year. We come up with a production curve, and then we look at the decline rates of how fast that drops off year by year. And remarkably, despite fewer rigs, active rigs running, we continue to produce more and more. So we're producing with 40% fewer rigs, over 20% more output here compared to 2018 and 19. This continues to improve because of the rig productivity gains. If that was starting to shift, maybe you would change your outlook for US production, but this is really key. It's a key fundamental to understanding as to why people have continually underestimated the US shale revolution and why it continues to remain on track. So that's a lot of information and a tour around the world very quickly. I will end there. I'll invite you to take a look at our website, the weekly chart book, the monthly energy economics review, and then always the latest of the quarterly that's available there. So let me stop
Thank you
sharing
so
and open to questions.
Thank you so much, Dean, that you packed a lot of information into 30 minutes here. This is like we could talk about all of this for 6 months. So let me give our audience a little bit of time to submit some questions. If there are any questions, please go ahead and submit them now. I don't know if Julie or Rebecca can see the questions coming in. Let me see.
You might have some questions off the bat, though.
Yes, I have a lot of questions, but
there aren't any submitted yet.
Oh, okay. Yeah, that's what I see. I just wanted to make sure. So if anybody has, oh, we get some questions. Perfect. That's great. Okay, the first question is, can you give a slightly longer term outlook on gas demand, 5 to 10 years into the future?
So I'm not showing numbers, but if we extended the charts out 5 and 10 years, and there's a lot of drift in that, right? I mean, from a US perspective, you would expect that both demand and supply in the trends that have been existing, that again, underlying production growth on the demand side domestically, starting before we go to the global picture, a lot of it is hung together because EI has projected basically a back substitution, like taking gas out of the power sector as more wind and solar capacity is built. We see it in ERCOT, we see it nationwide in terms of the projections. So that's why the EIA has continued to have export growth outpacing supply growth into the future. And that is a key assumption because this year with winter conditions, we saw a reversion back to gas. In fact, in non-emergency normal operating conditions, we've seen like almost every week, we see 90+% of ERCOT's power being supplied by thermal dispatchable sources. There's a lot of natural gas in there, 60 to 70% of it. So the longer term outlook hinges on these supply fundamentals continuing to play out at the same time as we get some substitution in the power sector. Otherwise, the availability isn't as great as apparent. In the official IEA and EIA projections, it's basically an elasticity versus growth. There's not a lot of detailed information in there, right? You don't have firm commitments out 5 and 10 years. You can do the math and figure out if I take a nice smooth curve diminishing from 2.5% year growth, I'm going to use that elasticity and have a broad expectation, give or take an overlay for some sort of fuel substitution based on individual markets. China's path will be really important. So what your view is in terms of China's growth 5 and 10 years from now, with all the things that have been going on, will also be important there. The official views will be that this is a market that, from a demand perspective, natural gas continues to grow. It continues to supplant coal in global power. It continues to remain cost effective, and you would see LNG growth. That's a nice, smooth thing, but then you need to think in terms of scenarios off of that. And the tariff situation that we're seeing, there are scenarios where this is something longer term, where it's a more structural change to the way energy markets work in the longer term. And I don't want to politicize it, but I also don't want to diminish the importance of thinking through some of the longer term implications of things that we're seeing in the short term.
So we have one international question here. Do you think the tendency with the oil prices will increase the next years if the conflicts in Europe do not resolve this year? So basically, if the Ukraine war doesn't resolve, do you think that we will see an increase in the oil price in the next years?
Well, let's go back to what's your baseline expectation. So the expectation that prices would come down is premised on part of putting Russian barrels, lifting the sanctions on Russia that make it easier to trade and grow. Despite the sanctions, Russia's basically held the line. OPEC Plus, Saudi Arabia in particular, has long wanted to put more barrels on the market, but has played a very active role in managing the market. So when you say, what do I expect in terms of price trends? Again, as a trade association, we're not offering a price forecast here. I can just say that you've got a pretty well-balanced market that's worked in a range for the last few years. Every time it's gone at or below around $60 per barrel, you start seeing announcements of less drilling, less production, domestically and internationally. Every time it goes up into the mid or upper $80 per barrel range, you have a pretty strong incentive to see cheating and less compliance within OPEC Plus, and more commercial supply being brought. So give or take the timing difference of conventional versus unconventional, especially globally, that's why oil has remained in this range as demand has been pretty much on track. So if you understand the demand side and your belief is that that continues to remain on track with no wholesale substitution or something structural with electrification, then this is a range-bound market. And you have to ask, short of a true economic surprise or shock, what will change it? And right now, the productivity trends, everything does look good to say that in the future, this is a market that continues to grow.
Yeah, so we have a few comments in there. I would like to ask people to formulate their comments as a question because I don't see in some of the comments, I don't see what the exact question is. This just as a side note. Then I see another question here that I would like to reformulate a little bit. So you showed in your presentation, Dean, that globally that about 1.8 million barrels of additional oil supply is expected in 2025 and 1.4 million barrels in 2026. And over 1 million barrels per day of additional supplies will come from non-OPEC countries of Guyana, Brazil, Norway, and Canada. So I have two questions here. So one of our anonymous attendees asked the question, given that countries would like to decarbonize, whether it's mainly the global south or Western countries producing, I don't know if you want to comment on the relationship between decarbonization and global supply or oil production decisions in certain countries.
Well, there's been an awful lot of policy impetus to try to jumpstart electrification in transportation in the US, globally. And we've seen some consumer backlash. We're seeing other issues that have made that go slower than some people had hoped. In terms of decarbonization, the more efficient way of being serious about this would have been to put a price on carbon emissions. You had European proposals going back 5 and 10 years where people, basically tried to put, firm carbon committed offsets in place. That market also hasn't really taken off the way it should, even under the UN's RED program. Why? Well, everybody has a nationally determined commitment, and they don't want to give that away. Everybody wants to lead in green energy. So there's been a selfishness in the way some of that's played out as well. So I think there's a natural tension because obviously you do have emissions as you continue to grow the use of fossil fuels. It has to be done in an environmentally responsible way. And we are seeing that both in the production of it, the emissions through some 27 voluntary US programs have continued to lower at least natural gas system, methane emissions. On the oil side, there's less emissions associated with the production of it, more on the consumption side of it. Uh, Barring a really transparent carbon price and market-based solution to this, I think my personal view is that it's only feasible for government to push this so far. At some point, consumer preferences really rule. And it may come, the technology, the best and most hopeful sign I've seen out of that is Toyota had an announcement of a solid state battery for as soon as next year that could get over 620 miles of range. If that kind of thing proves out, that would assuage a lot of consumers' angst about range anxiety. Uh, it would be a much more fungible substitute versus internal combustion engine vehicles. Personally, I drive a hybrid that gets over 50 miles a gallon. And I got to tell you, the cost difference of the amount of fuel you can burn driving, 15,000 miles a year at 50 miles per gallon versus an EV, the crossover doesn't make sense for that. So the question also is one of utility again, consumer preferences on a global basis. When you project it out, I think there's a range of reasonable outcomes. You have to look at what the auto sector is doing now that it can't necessarily depend on public support to continue to just push electrification. It's getting grounded more in the economic reality. And then the supply chain realities, especially in North America, are really structural as well. I watch China. I watch what's happening with BYD and those trends and whether they'll continue to grow globally. It's really interesting. I think as a fan of technology, I'd like to see this continue to play out and be competitive. But these options are going to have to stand on their own because the notion that government can just continue to subsidize it for everybody, that's not going to work. So it's going to have to be a market-based outcome once it reaches critical mass in terms of its functionality and its volume.
Thanks for that. Yeah, continuing on that question. So, as you mentioned in your presentation, there is a slight, I mean, we have a little bit of an oversupply outlook for 2025 compared to demand, right? But it's actually pretty, I mean, we can't really forecast the relationship of supply and demand despite the forecasted little bit oversupply that we see, right?
Well,
So, yeah. So my
well,
question,
okay,
yes.
go ahead. Sorry.
Yeah, maybe you want to say something first and then I go ahead.
Well, the EIA projection actually shows global stock withdrawals. So some stock building perhaps in the US here, and we're seeing that
Okay.
recently, but on a global basis, they've got prolonged stock withdrawals. And what was interesting between the International Energy Agency and the Energy Information Administration, if you were contrasting the first quarter outlooks here, IEA was projecting large stock builds, as you were, just kind of, an oversupply situation like you were just talking about. And EI had the opposite. And it's not common that you see the official agencies directionally different in terms of whether they see stocks going up or down. I mean, a matter of degree or difference, yes, but directionally different, that's fascinating.
Yeah. But can you explain to our audience how these developments of supply and demand, how these developments put some pressure on OPEC and OPEC Plus, and how OPEC's decision have become crucial in terms of the price outlook for this year and maybe next?
Sure. So let's start with what OPEC needs, and they really work from budgetary assumptions of for the spending programs they have within the country, what they're trying to raise in terms of government revenues. Most of this is, national oil company produced oil and products, and then, trying to make sure that there's, to the extent you have a petrochemical sector tied with that, that you're in a potential long-term oversupply situation, maintain your consumer and customer relationships. So through the value chain, you always have a market for your product. What you're looking at in terms of trying to manage that today is that it, it really does depend on whether demand continues to have the headroom to enable that supply growth. Because the base case here is that we're adding, again, 1 to 2 million barrels per day of demand per year. That enables OPEC to turn the dial to a right, open the spigots, put more supply on, meeting some of their financial commitments at the same time. It just alleviates pressure all around. If you got a negative economic surprise that really squeezed the balloon and demand was lower or demand growth was lower, uh, yeah, the non-OPEC stuff like Guyana, that's coming regardless. It's going to, if you think of it in economic terms of the residual demand curve, your long lead conventional project that's baked in and committed, those barrels are coming whether you like it or not. You're not going to, hold it and produce less as a result. The US can respond relatively quickly, and you can see less drilling activity and see a balancing mechanism there, but it doesn't play a concerted market balancing role the way OPEC Plus historically has. So look, I think it holds together if the economy holds together here, and it's just a question of, do you see a reasonable, plausible scenario that takes it off of, something, if it's a tenth or two of a percent per year in terms of global growth different, this all holds together. You're really looking for something. Do I see some breakage along the way as a result of people just getting to the point where the stresses are too large? That's where we could really see the role of OPEC Plus changing in that. But right now, I think it's congruent with what we're showing in the outlook here.
So Andrew Slaughter asked another question. Do oil prices really drive do oil prices really drive drilling economics in the onshore US, given the high volumes of associated gas and NGLs?
Well, if we go basin by basin, the Permian Basin is the only one that grew materially last year. And there's associated gas that's coming with it. But at times in the Permian Basin, you're having to literally give the gas away or pay somebody to take it. In West Texas at the Waha Hub, we had a lot of time last year where the prices actually went negative. Think about that. I mean, Henry Hub may have been still $2 per million BTU, but Waha was basically nothing. And this is important because it really does say that oil is your primary driver. Liquids, associated gas, and taking wet gas and getting NGLs. There's value there, but it doesn't really move the needle. It's just when you start seeing LNG exports accelerate, you will get more activity out of dry gas plays like the Haynesville in East Texas and Louisiana. Very little NGLs coming out of there, but supporting again an export-led kind of option. The main activity, in addition to supporting LNG exports, the main activity has primarily been the oil price, and I think it's as important as ever.
Thank you. So Michael Ebers is asking, we show the Canadian imports as a cost, but we are getting it at a discount of $10 per barrel. But exporting light oil at plus, say $3 per barrel, not to mention exports of refined product at 20 plus dollars per barrel. And then he says, so we are not in a trade deficit on oil and natural gas.
Not overall. With Canada, we certainly are from both an oil and a gas perspective. I think heavy oil from Canada plays an important role in the market. It provides for product diversity. Again, refiners have sunk billions of dollars into complex, thermal cracking, coking capabilities that are dedicated to having that kind of heavy molecule to put through it. And without that, and you don't get the same variety of products coming out the back end of a refinery and petrochemical integrated process, right? So as it comes, today, looking out, Western Canadian Select's sitting around 55 a barrel at the same time that WTI is roughly, just above 70, right? So call it you know, we need to see, but based on a $15 to $20 light heavy differential between Western Canadian Select and WTI. In that range, historically, that's where it's worked. If it gets up and it stays above 20, you print money all day by using heavy oil. If it gets under about $10 per barrel, historically, that's where refiners say, no, it's really not worth it. And I start with the transportation costs. And some of this goes by pipeline easily to the Midwest. But if you're getting down to the Gulf Coast with Canadian crude, you're adding $5, $10 per barrel just in terms of using rail or trucking to get it down at that point. So your crossover, I think it does have value. I think, but I wouldn't simplify it of just saying, well, I'm getting this discount and I'm exporting this other thing that's lighter at a higher value. You have to think of it in terms of the sunk investments that are there, the products that you're getting, and the product mix that you're getting off of it. Understanding the economic decisions, both of what you process and how you do it. The best example I can give you, and I mentioned 2018 and Alberta's production restrictions. Canada really lost market share off of that. And here, if we're talking, and the numbers to the day, I'd have to look them up, but a 10% tariff on Canadian crude, some of which will probably be absorbed through currency depreciation and some of it through the Canadian producers. In the last month alone, WCS has come down more than $5 per barrel, right? Along with the broader crude oil complex. So it's not lost in the rounding. It is important, but it won't structurally change the market at 10%. But if all these tariffs ramp up to 25%, and you're talking about a $13 tariff on top of Canadian oil, at that point, if you've only got a $15 to $20 light heavy differential, the economics just don't add up. You can't make this work on $5 per barrel difference. You will shift. You will invest to upgrade the bottom of the barrel, or you just won't run the crackers and cokers. So I do think that there needs to be uh, a cogent federal policy that understands why we continue to import and trade the way we do, and the fact that despite a lot of market conditions over time, everybody's expected that these would just go away, but the imports that remain, they remain for a reason. And by the way, we also took about $5 billion worth of Venezuelan crude last year. There's a need for that. Some of it's just the opportunity economically to process it, but there's a need for these heavy molecules because the equipment's there to process them.
So actually, I saw yesterday that the Trump administration will not renew its permission for Chevron to get Venezuelan oil to the U.S., right? What will be the effect of this, in your
Well,
opinion?
because we had gotten by without any Venezuelan crude for a long time, I don't think from an overall market balance standpoint that it's anything more than a net. You can substitute, whether it's from Colombia or West Africa or Iraq, you can bring in other grades of heavier oil. They're just not as heavy as Venezuelan or Canadian oil. So you're putting it through the units, but it's not the same output or efficacy or discount for that matter. Um, Being able to, on the Gulf Coast in particular, to get more Canadian crude has been limited by the fact that the Keystone XL pipeline, it was nixed after TC Energy having spent billions to try to advance it. I think there's an administrative, federal desire to try to rejuvenate that program, but I can't
We don't
predict
know.
it, but I don't see it.
Yes.
Well, it's highly uncertain, and
Yeah.
because that's a hull that's been burned down before, it's hard to just bring a project back like that, right? Investments have already been made in the refining sector to try to work around it. The question is, and where I think the last question was also thoughtful in looking at those margins, is if I start to combine retaliatory tariffs that are symmetric with the import tariff, now I've basically really narrowed my range of acceptability for how much the system can sustain and remain competitive with the feedstock advantage that the U.S. has. In that case, that's where you're talking about the investments it made in refining with the feedstock advantage that's similar in the Middle East to be able to really take a leadership position.
So we're almost out of time, but I would like to ask one last question, which is, What effect do you think would an escalation of the current conflict between Israel and its neighbors or Israel and Iran have on oil markets?
It's a really great question. I mean, for everything that, and think about all the uncertainties that we've ridden through in the last year or two here. Um, the oil market hasn't really factored a lot of that in, except for when the potential for more broadly involving Iran, again, Straits of Hormuz, Iran itself exports over 3 million barrels per day, but a lot of the trade goes right by them, right? So if they wanted to be disruptive, they could be disruptive, but we've also seen where the market has worked hard with back channels on diplomacy to try to avoid those scenarios. So when it seemed clear late last year that there was an opportunity for Israel to counter with attacks directly on Iranian oil infrastructure, they didn't do so. And it seemed like diplomacy worked and that they found a way to work around that. With this administration, I don't know what their policy on Iran vis-a-vis nuclear considerations will be. I think it will probably be worked in a way that's, you're getting another degree of freedom in terms of Russian barrels potentially coming on market if Russia-Ukraine gets resolved. So again, the market's been finding a way, and we haven't seen the doomsday scenarios of big supply shocks really playing out in terms of consumers' pocketbooks. It's been other forms of uncertainty that have really affected it.
Thank you, Dean. Thank you so much for a whole hour of enjoying your knowledge here. I thank our audience as well for taking the time to attend, and I'll give it back to Rebecca.
IAEE would like to thank Dean Foreman and Isabella Ruble for an outstanding webinar. This webinar will be available on IAEE's website for future download. We thank you for attending, and I officially close this webinar.